Hello everyone, welcome to chapter 2 of the Access Circle. In this chapter, we're going to dive deeper into the core concepts. Okay, so before we even begin this chapter, I just want to quickly talk about why this chapter even exists in the first place. Now, here's the thing. I know that you probably already know or you've probably already learned each one of the foundational concepts. Okay, whether it's market structure, whether it's the open high low close framework or SMT, I know that you've learned a lot about them. But the truth is that knowing each one of them, no matter how much you know about them individually, doesn't mean anything. It doesn't mean shit. Okay? Knowing each one of them in isolation is not enough and it won't work for you. And that's the reality for most traders. Most traders stop at surface level understanding. They know what each concept is, okay? But they never learn how those concepts actually work together. They don't know how to link them or how to build buys with them or how to time trades using all of them. Okay? When it actually comes to integrating those concepts with one another, when it's actually time to turn it into a system, something that actually has structure, rules, and logic behind it, that's where they fall apart. That's something that they don't know about. Okay? And to fill that gap and to fill that void, I've made this chapter. Okay? This chapter is going to be all about connecting the dots together or connecting the concepts together. And within this chapter, we will dive deeper into how these concepts interact with each other, the nuances of these concepts, and how they interact with each other, how they are dependent on one another, and more importantly, we will discuss the structure in the frameworks that ties all of those concepts together into a single systematic model which you can actually execute and something that's actually uh, consistent and mechanical with proper rules and proper frameworks and logic behind it. Okay, that's going to be the objective of this chapter right here. Okay, now let's move on to the next slide. The first thing that I will say here is that don't think of the access model or the access system as some sort of like a linear checklist of concepts that you apply one after the other. Okay, that's not how the access system works. In my opinion, that's the wrong approach. And the system that I've designed or that I've built or that I've made is not structured in a way where I use the concepts in like a checklist sort of fashion. Okay, instead, I've designed it so that it's a web. Okay, it's a web. The access model is a web. It's a complete network. And within this network, each concept and each element does not operate alone, but rather each one of them are integrated with each other in a way that they feed into one another, relies on one another, and confirms each other. Okay? None of this stuff exists in isolation. And what I mean by that is that I have designed the access system in a way where the frameworks within it have such step-by-step procedures in which I use multiple concepts together to establish or achieve single objectives or single functions in a systematic manner. Okay? And then within those frameworks, each concept plays a key role, and together they either confirm each other and establish a particular objective like establishing or determining a directional bias, or they systematically reject each other through proper logic and proper guidelines and protocols, which in turn leads to the invalidation of a bias, which is just as important as building a bias, because obviously trading isn't just about when to trade but also when not to trade. Okay, so the point I'm trying to make here is that all of these concepts are connected together within this system. Now let me walk you through the different layers and the different frameworks that I've prepared, and let's see how they work. Now at the top, the first layer that we've got is the directional bias layer. And this is where your idea begins. This is where your trade idea begins. It's your starting point. This is where you start. This is where you ask, where does price wants to go? And each concept, all of the concepts and this layer are used for one purpose only, that is to determine the directional bias for the day or to determine the drawn liquidity on the higher time frame for the current day. Okay, this layer is all about forming the initial direction. This is basically the first filter. And then once that's established, once you've established the directional bias for the day, we then move on to the next layer of the web or the next layer of the network, which is called the contextual layer or context layer. And this is where your idea or bias either gets confirmed or qualified or it gets rejected. Okay, and what you do within this layer is you identify a proper market context on the intermediate time frame within this layer to determine whether it's the right time to trade or not. Okay, you assess and measure or check the market conditions and the market context and the behavior and position of price, and then with the help of those factors or those elements, you decide whether today is worth trading or not. Okay, and those elements or those factors help you with your idea either getting confirmed or rejected. Okay, let's say you are watching the intermediate time frame, which in our case is the 4-hour time frame. Let's say you're watching it and you see that price is around a proper key level and a proper CRT within a dealing range, and that dealing range is aligned with the higher time frame directional bias. And that context and that scenario, that leads you to your idea being qualified. Okay, meaning it shows that the current market context is high probability, it is aligned with the higher time frame directional bias, and now you can trade within it. But if the behavior isn't right, if the context isn't right, it isn't aligned with the directional bias layer, or the market conditions aren't right, which we will discuss in the later slides, then the idea gets rejected, and then you do nothing. And what you do is you wait patiently for either a proper context to be formed or you wait for the next day. Okay, it's also one of the main layer where most traders go wrong, because they either force a false narrative, a false market context, they force a false market context, or they ignore the invalidation signals or the invalidation signs from the market conditions. Okay, but if you get this right, if you get this layer right, then with the help of this, you filter out 90% of the losing trades or 90% of the shitty trades or the invalid trades, you could say. Now, I'm not saying that you will have a 90% win rate here. I'm just saying that you will avoid the invalid trades here if you get this layer correct or right. And once you've established the context, or once you've qualified or confirmed the trade idea, then we move on to the execution layer. And this is basically the last filter or the final filter. And this is where either you take the trade, either where the trade is finally taken or it's skipped. Okay, it's where you either step in or you sit the fuck out. And I've prepared a systematic framework. I've developed a systematic framework for this layer as well, which you're going to see in just a few minutes. Okay, and this right here, when you use the concepts in this sort of fashion where you have proper systematic frameworks for it, that's where the real edge comes from. Okay, the real edge comes from proper alignment and proper integration. And that's what makes this web, this network so powerful. Okay, because they are connected with each other. Now, if you think that what I just said in this slide is a bit too vague or too subtle for your understanding, and obviously don't worry, this is just me explaining or introducing you to the frameworks or to the layers. I'll be going over these layers in much more detail in the later parts of the chapter. Okay, and by the end of it, I can assure you that you'll know everything about it. So, first of all, we will discuss this directional bias layer, and then we will move on to the other ones once I've broken this down properly for you. Okay, so this layer right here is where your entire trade idea begins. This is where you start your analysis. Okay, and the thing is that before you even think about the other stuff like entries or key levels or building or establishing a context or a market context, you need to first of all know and you must understand where price is likely headed and why. Okay, and that's the whole job of this layer right here. Now this layer has three core components. Okay, the first component is obviously the time frame. The first main important task to do is to define the time frame that matters, because obviously you can't analyze the market unless you define which time frames matter and which time frames to use for this particular layer or this particular framework. Then using those time frames or using that time frame, we then get to the second component, which is structure. Now within this component, we use the relevant and the correct concepts to determine market's direction or build a directional idea. Okay, this is where within this component of the directional bias layer, we determine or we figure out the market's direction. Okay, this is where you actually figure out the direction of the market. And then once we figure that out, we then move on to the third component, which is narrative. And this component, obviously, just as the name suggests, it involves building a narrative. Okay, and here's where everything comes together into a single cohesive story. Okay, obviously, because you can't just say price is bullish, you need to know where is it headed, meaning where is it going to go, and most importantly, you need to know from where is that move starting and when and how. Okay, you need to know the logic behind that move, and that is what we call narrative. That's our narrative. Okay, just knowing the direction of the market or the structure of the market is not enough. We need to know, first of all, where is price likely headed to. Number two, from where is this move starting? Okay, meaning where is the origin of this move? And number three, when is that move going to start, or when is the highest probability, or when is the highest probability for price to start that move or start that expansion. And then last but not least, we need to know the logic behind it, the why behind it, okay, the reasons behind it. So, and those four things are figured out by this component right here, and that's what we call narrative. Okay, this is basically where everything above gets fused into one cohesive directional story. Okay, it's not just about where price is likely headed, it's also about from where is that move likely to begin. Okay, and once you've worked through all of these components, all of these three parts, you figured out the time frame, you've determined the structure, and you've built a proper narrative, that's when this layer actually starts to mean something. Because at this point, you're not just guessing anymore, okay? You're not just predicting anymore. Instead, you actually have, at this point on, you actually have a clear and a logical directional bias, not just a directional idea, but a directional bias. Okay, you're not just saying that, okay, price is bullish or price is bearish is like a vague statement, but instead you know why is it bullish, what's causing it to be bullish, and where is that bullish range expansion going to originate from. And then correctly following this layer in its components, that leads to three potential outcomes, or I'd say three definite outcomes. Number one, you'll know which time frames to use. Okay, you'll know the correct and the relevant time frames to use to achieve the objective for this layer, which is this right here, which is establishing a directional bias. And then using those time frames, you will understand what structure is the market moving in, meaning you will know the underlying directional idea that the market is moving in. And then using the concepts within this component, this narrative component, you'd then be able to build a successful narrative, meaning a successful or a proper narrative that not only explains the destination for price, meaning the drawn liquidity for price, but also the origin for that range expansion or for price, meaning where will that move begin and when. Okay, and then only then you would have a directional bias that's actually useful, that's actually clear, and one that you're going to be confident in. Okay, that's the objective of this directional bias layer. Now let's move on and let's discuss each one of these components in more detail. So first of all, we've got the time frame, and within the XS system, the relevant time frames for this layer are the monthly, the weekly, and the daily time frames. What this means is that you're going to start your analysis with the monthly time frame at the start of the week, and then using the concepts that I'll be showing you in the next slide, using those concepts, you will be building a directional idea, then establish a directional bias from that idea. And then once you've done that, once you've successfully done that, you'll then move down to the weekly time frame and repeat that same process and refine that directional bias down to the weekly and then to the daily time frame. And then by the end of it, you'll have a clear and a definite directional bias for the day. And then your objective for that particular day would be to look for context or establish context, market context, or to frame trades in that particular direction. Okay, now let's move on to the next slide and let's discuss the second component, which is structure. Now we've already discussed what it does or what is the purpose of this component, but let me just quickly reiterate it. Just like it says here, structure helps us with determining where price is currently headed, not in terms of right direction, but also in terms of its path and flow. Okay, structure determines the journey of price action, meaning what is the underlying directional idea here, and then using that idea, narrative determines the origin and destination for price or for that move. Okay, now I'm going to quickly go over the concepts used within this component. I'm not going to dive deeper into the actual procedural frameworks or the step-by-step procedures in this chapter because I've already prepared separate dedicated chapters for that. But for now, let's just quickly go over this. Now, the concepts used within this component are divided into two categories, the primary concepts and the secondary concepts. Now, the main two differences between the two categories are that first, the secondary concepts are only used on the monthly time frame, on the monthly higher time frame, whereas the primary concepts are used on all of the three higher time frames, the monthly, the weekly, and the daily. That's the first difference between these two categories. But that's not even the main difference here. The main difference is how they are used and what sort of element they add to our analysis. Okay, and another thing is that how they are related to the technical aspects of the charts. And what I mean by that is that the secondary concepts have very little to do with the charts or candles or price action. Their idea or their main premise is derived from past historical behavior of a particular asset. Okay, let me explain what I mean by that. So you can see we've got two concepts within this category. Okay, first the quarterly framework or the quarterly shift framework, and then the seasonal tendencies. Now the quarterly framework is basically looking at price and seeing whether what has it done in the past or the previous 3 to 4 months, or or asking yourself what was the predominant direction of price in the past 3 to 4 months, and then based on that idea we can build a macro directional context or a macro directional idea. And the underlying idea within this concept, within the quarterly framework, is that each every 3 to 4 months we have a quarterly shift in price action. Okay, every 3 to 4 months price action shifts and we move into a new trend. The underlying trend changes and we move or shift into a new trend. That's the underlying idea within this framework right here. So using that idea, you can build a directional idea and then establish a bias from that. Okay. And similarly with seasonal tendencies, with it, we just look at a seasonal tendency chart for an asset and then we build a directional idea by looking at that seasonal chart, which basically shows us how a particular asset has behaved in the past 20 to 30 years throughout the year. And then using that seasonal idea, you can combine it with the quarterly framework, and then using those two together, you can create a macro directional context on the monthly time frame. Okay, so that was the secondary concept category. Then apart from it, we've got a primary concept category, and within this one, we've got these three concepts: liquidity metrics, market structure, and market profiles. And these are basically the technical drivers, meaning you will be actually using these concepts to look at the chart and analyze price action with it, and then use all of these together. You will be establishing a directional idea. Now let's move on to the next slide. So this is the final part of the directional bias layer, or the final piece of the directional bias layer. And this is basically where everything starts to click together. This is where everything that you've built so far comes together into a storyline that you can actually trade. Okay, you've already figured out which time frames you're going to be focused on. You've then, using those time frames, you've defined this structure on the higher time frames and you've built a directional idea. But now the question is, how does all of that come together into something that you can actually trade? How does all of that come together into something that you can actually use to frame trades? And that's what narrative does. Okay, narrative transforms that directional idea into a proper and a feasible directional bias for the day or for your current day. Structure gave you the direction, but narrative gives you the storyline. It helps you answer the two most important questions you need to figure out before even thinking about execution. And they are, first of all, knowing, or let's say you figured out that the directional idea or the underlying directional idea is bullish and the market is moving in a bullish trend. Okay, or the market is moving in a bullish direction. So now you know that the market is bullish and it's going to go higher. But the question more important than that is knowing where is that bullish move going to originate from, or where is that bullish move likely going to start from. And that's more important because that's where you will be actually trying to frame your trades. That's where you will be framing your trades. And if you don't know the origin of the move, then maybe you will enter maybe a bit too early or too late. And those are two things that you want to avoid, because if you enter too early, then you could be stuck in a range, or you could be taken out of the trade due to a manipulation profile. Or if you enter too late, then that could lead you to entering in a position or in a way that could leave you susceptible, or you could say exploitive, no, not exploited, that could lead you susceptible to retracement profiles, and maybe those retracement profiles could take you out of the trade. So knowing where the origin of that move is going to be is actually more important than knowing the direction of the market. And that's what narrative helps you with. That's what narrative answer. That's the question that narrative will answer for you. And then the second question is, where is the move likely going to end? Or basically knowing what is the drawn liquidity for price. Because if you hold the trade for too long, then that could lead to price reversing on you, which is also something that you'd want to avoid. And that's what makes this component so important and so significant. It takes your directional idea and turns it into an actionable and a feasible anticipation for price, meaning that now you know when to actually look for a trade, and also when not to, and how to actually approach price the correct way. Okay, it helps you answer these three questions. Are we about to begin a real expansion? And if the answer is yes, then where should that expansion originate from? And then last but not least, where is the cleanest and the most logical place for that expansion to target? Okay, or you could say, where is that expansion going to end? Meaning, what is it, the drawn liquidity for you? Okay, so this component is not just about guessing the direction or predicting the direction, it's about turning your idea into a bias, into a plan, that into something that you can frame trades around with clarity and with confidence. Okay, so that is what it does. Now, in terms of the concepts used within this component, we use mainly two concepts. First of all, dealing ranges, which helps you identify price's position in the current expansion leg or the current range, and lets you answer whether price is in premium or discount. Okay, and that helps you anchor price or anchor the position of price. And second, we use key levels, which help you refine the starting point of a move and the ending point of that move. Okay, it lets you frame potential reactions. Now, obviously, it seems a bit vague here, and you don't know how to actually do these things on a live chart or on an asset. And for that, you'll have to watch the next chapter. Okay, so don't worry about that for now. So once you've figured out and built the directional bias for the day, meaning you know in which direction are we going to have a range expansion, or and when, where is that range expansion going to originate from, and where is it going to end. Once you figured all of those three elements, you then move on to the next layer, which is the context layer. This is the second layer of our framework. And this layer is basically where your directional bias meets real market behavior. Okay, this is basically where you take a step back and use the concepts or the components within this layer to figure out whether it's the right time to trade or not, or whether it's whether we have the right environment or the correct market conditions to take action or to frame trades or not, or should you just sit out and wait until the right conditions appear. Okay, this is basically the main function of this layer. This layer filters out the noise, adjusts your position to the current market conditions, and basically helps you answer this question right here. Okay, this layer has three components, three core components. First of all, time frame, the exact time frame that you'll be using for this layer. Market context, meaning identifying the correct key levels and the correct candle ranges within a relevant dealing range on the intermediate time frame. And then market conditions, meaning looking at weekly profiles, daily profiles, macro news events, and the previous day's behaviors to see whether we can have a range expansion for today or not. Okay, and then those three core components help you answer these two questions. First of all, is it now the right time to engage, meaning is it now the right time to frame trades on the intermediate time frame or not? And number two, is the market in a condition that favors my entry model? Okay, that's what this layer helps us with. This part of our framework prevents us from chasing or forcing our bias in the wrong context. Now let's move on to the next slide. So right here we've got the first component of the context layer, which is the time frame. And within the access system, the only time frame we're going to be using for this layer is the 4-hour time frame. This is also the intermediate time frame for the access framework. And in my opinion, this is also the most important in the significant time frame, because the things that we're going to be actually doing within this time frame or on this time frame are much more significant than just knowing the directional bias for the day, because within this one we'll not only be building a proper market context, which we will be using to frame our execution or frame our trades, but also we'll be figuring out and assessing whether we have the correct or the relevant market conditions that actually gives our entry or our model a proper technical edge or not. And that is why this context layer is so important in my opinion. And this is the time frame that we'll be using for that purpose. Okay, now let's move on to the next slide and let's discuss the second component, which is market context. Now, market context is basically where the actual trade idea is born. Now, the directional bias layer is where the idea begins, but this is where the trade idea is born. Okay, and within this layer, you will actually be establishing or developing a market context, just as the name suggests, and then you'll be using that context to frame trades or frame executions on the lower time frame. Okay, and that's actually more important than knowing the directional bias. Directional bias gives you the where, but context gives you the how. And because of this part right here, because of this how part, this component is also similar to the narrative component of the directional bias layer. Because within the narrative component, our objective was to determine the origin and destination for the move, but we were doing that to establish a directional bias on the higher time frame. But now within this component, we will be doing the exact same thing as we did in the narrative part, but we will also be adding a candle range there, and that whole context will be used to frame a execution or frame a trade on the lower time frame in a logical manner. Okay, and the reason a proper market context is so important is because without a proper market context, even the strongest directional bias becomes useless. So not only you will be establishing a context on the higher time frames, but also you will be repeating the same process on the intermediate time frame and establishing a context even here as well. Okay, because obviously you can't just trade because price is bullish or bearish. We've already discussed this. You will trade because context aligns to present a valid scenario for action. What that means is that you need to trade because the context aligns, and that gives you a valid reason to act. And that's the difference between chasing moves and catching them properly. Now, a strong market context or a high probability context has three essential components. Number one, a proper and a relevant and a valid dealing range. Number two, a proper key level relative to that dealing range. And number three, a candle range. And that's what a high probability context looks like. Okay, and this context right here is the filter that keeps you from trading invalid setups or dumb setups just because you felt bullish or just because the directional bias was bullish. Okay. And then we have the final component, which is market conditions. Now, this component is also really important because it acts as your final filter or your last filter before you move into execution. And this is also what separates disciplined traders from people who trade every candle, every setup, every pattern, and then they wonder why they keep getting chopped up. What I mean by that is that you could have the best directional buys or the most perfect market context, but if you're not trading within the correct market conditions or the right market conditions, you're still going to lose. And to avoid that, you need to make sure that the market conditions are also right. You need to assess that the market conditions are also right. And when I say market conditions, I'm referring to three key things. First of all, the time of the day. And this means checking whether we are trading within a key time or not, or whether we are actually trading within a kill zone or not. Are we in a high probability time window for a range expansion? This is basically figuring all of those things out. Okay, and this alone can make or break your trade. You could have all of those other elements figured out, but if the time of the day isn't right, you're still going to lose. So this is also important. You need to figure out that you need to make sure that you are trading within a key time at the correct time. Okay, second thing is the time of the week. This is about looking at the weekly structure and figuring out whether we've already had our weekly range expansion or not, or whether we can still ride it. Are we still inside a dealing range, or are we still looking for the high or the low of the week? And this basically helps you avoid forcing trades when the market isn't ready. For example, let's say we've already had our range expansion at the start of the week and at the middle of the week, and now on Friday you have a good directional bias in a proper market context, but if the market has already capped its weekly range, it has already expanded enough, then you're going to avoid trading on Friday because there's going to be a TGIF profile or a Friday retracement profile. So in that case, if you had avoided or if you had ignored the market conditions regarding the time of the week, then you would have lost. So this is also something that you would want to avoid. And number three, we have macro and news events, which is basically filtering out major news events like NFP, CPI, or FOMC, because for me they are usually off limits. Price is unstable on those days, and models tend to break. And this isn't just me saying it, but also ICT says that as well. And this isn't about being scared. Okay, checking the market conditions or assessing the market conditions and waiting for the correct ones isn't about being scared, it's about being smart, because market conditions is actually what tells you whether your technical edge is active or it's not. Okay, so don't skip this part and understand that it's what keeps you from forcing setups in the wrong environment. So this one is also a really important one. Okay, now let's move on. So by the time you've worked through both the first layer and the second layer, you should be super clear on two things. First of all, you will have a clear and a solid and a strong directional bias with a clear drawn liquidity. And number two, you've got a filtered and a well-defined and a high probability market context and filtered conditions that validate that initial directional bias, which basically means that you know where is price likely going or where is price likely headed. Number two, you know where that move should actually begin, or you know where that move should actually start expanding from. And most importantly, you know whether the current environment is even toward trading or not. You know if the current environment supports taking action or executing or framing trades or not. Okay? And by this point, all that is left is now to wait for your entry setups, move on to the execution layer, and then follow the protocols within that layer. Okay? Okay, so right here, let me just quickly summarize what we just went through in the first two layers, and I promise I'm going to keep it quick and short. I just want to give you a graphical representation and a graphical overview of what we just went through so you understand this better. Now, obviously, I'll still be going over the exact step-by-step frameworks and the detailed live examples of it in the trade breakdowns of this framework later in the access circle. But I still want to give you this overview, this quick overview here, so you don't leave this chapter on a bad note. Okay, so first of all, we discussed the directional bias layer. Directional bias layer, and the objective of this layer is to establish or to determine a directional bias. Okay, and this directional bias will be just for the current day. Okay, not tomorrow, not the day after tomorrow, but for the current day. And within this layer, we first of all defined the time frames that would be focused on, and they were the monthly, the weekly, and the daily time frames. Then we had the two technical components. First, the structure component, whose job is to basically establish a directional idea, and then the narrative component or part, where we will basically turn this idea into a directional bias. Now, what I mean by structure here is that structure is all about, let's first discuss structure. Structure is about figuring out whether the market is going higher or it is going lower, whether the market is in a bullish trend or is it in a bearish trend, whether are we going to have a bullish range expansion or whether we're going to have a bearish range expansion. This is what structure is about. This is basically about knowing the direction of the market or the underlying directional idea of the market or the underlying direction that the market is moving in. But obviously this alone isn't enough. We still have to figure out the origin and destination, and that's what narrative does for us. So narrative, where is it? Narrative helps us with determining or figuring out the origin and the destination for that range expansion or for price. What that means is that, let's say we figure out that the structure is bullish. Okay, we know that the market is moving in an underlying bullish direction. Okay, the direction of the market is bullish. But now let's say this is the daily time frame. Okay, we will be repeating or replicating this exact process on the monthly, then we'll refine it down to the weekly and then to the daily. Let's say we're looking at the daily time frame. On the daily time frame, using the primary and secondary concepts within the structure component, we figured out that the structure is bullish. We are moving in a bullish direction. But now we have to figure out where a range expansion could begin. Where is the origin area for a range expansion to begin, and where is that range expansion then going to end? What that means is that, the structure is bullish, but if we are going to have a range expansion, if the idea is that we have to anticipate a range expansion, where is that range expansion going to begin? Are we going to expand or immediately from here, or are we going to retrace till here and then expand, or Are we going to come down lower, test a key level, and then expand from there? And narrative is all about figuring this out. And then it's also about determining where is this range expansion going to end. Is it going to end here, here, or there? Okay. And to figure this out, we talked about using dealing ranges and key levels. So what are you going to do in this scenario is that you're going to draw out the dealing range on the daily time frame for your current expansion swing or dealing range, which is this one right here. And then you're going to identify the relevant key levels within it, which will be somewhere right around here. Let's say we have an order block here. So now on the daily time frame, you know that the range expansion, the origin for the range expansion is right here. So obviously your first anticipation for price would be to retrace lower and then expand from there. Okay, your first expectation for price would be to rebalance this dealing range, reach this origin, and then from here it will begin its expansion higher. So by using this logic, this would be your short-term drawn liquidity with your long-term drawn liquidity being higher. Okay, so using narrative, so if you were just using structure alone, then obviously you would have straight away expected bullish expansions, immediate expansions. But because of using narrative, you determined the origin and the destination for price. And by using that logic, by using that rationale, you also figured out the short-term drawn liquidity for price. So now you know that first of all, it has to retrace in the short term to rebalance the dealing range, reach the origin, and then expand from there. So throughout this whole time from here to here, you would have expected, anticipated bearish price action. And then once it reached this origin right here, which is in this case, then from there, you would have, your directional idea or your directional bias would have changed into bullish, and then you would have expected or anticipated price to have a bullish range expansion higher. This is basically what narrative helps you with. And then once you've accomplished this part and established a directional bias for the day, you'll then move on to the second layer of the axis framework, which is the contextual layer or the context layer. And then within this layer, the first job is to identify a proper market context. And after identifying a proper market context, the second thing is to assess and check the current market conditions and figuring out whether it's the right time or the right environment to trade or not. Now, identifying or developing or establishing a market context on the intermediate time frame, obviously for the context layer, we will be using the 4-hour time frame. Establishing or identifying a market context on the intermediate time frame is similar to this narrative part. What I mean by that is, let's say we are looking at this move of this daily chart and prices, let's say right here on the 4-hour time frame. Let's say we are looking at this move on the 4-hour. This will look something like this. Okay. Okay. Something like this. So on the daily time frame, using this narrative part and using the traditional bias layer, when price was right here, you determined that our directional bias for the day is bearish and the short-term drawn liquidity is here because the origin for the bullish range expansion is lower, and the bullish expansion will begin once we rebalance this dealing range. So let's say today is Tuesday. So for Tuesday, your directional bias for the day would be bearish and your drawn liquidity would be this key level, this order block right here. Okay, so now we are looking at this price action on the 4-hour. So on Tuesday, let's say on Monday, price did this. Price took out this high, formed the high of the week, and then closed lower and had a change in the state of delivery or a structural shift. Now Tuesday opened right here. Now your job on Tuesday within the context layer on the 4-hour time frame is to identify a proper market context, which means identifying a proper origin for a range expansion on Tuesday, which basically means is that if we are expecting Tuesday to have a bearish range expansion lower towards the short-term drawn liquidity lower, then where is that range expansion on Tuesday going to originate from? Where is the origin of that range expansion going to be? What is the catalyst going to be for that range expansion? Are we going to expand straight away immediately like this, or are we going to first of all rebalance higher, rebalance this dealing range, test a premium key level within this dealing range, form the high of the day here at a key time, and then expand lower once we have proper confirmation? Which one of the two scenarios is more likely? Whether expanding immediately straight away without doing any of this is more likely, or the other one? And the contextual layer on the 4-hour time frame, on the intermediate time frame, is all about figuring this out. And out of these two scenarios, this one is more likely, because based on the open high low close concept, based on key levels, based on dealing ranges, based on everything that we've discussed so far, this is the move that is more likely to happen. Okay? But the thing is that it doesn't just end there, because even when you've identified a proper market context, the next thing that you're going to do is then check and assess the market conditions. You're going to ask yourself and check and assess whether we have a major news event on Tuesday, whether we have a CPI or FOMC news event on Tuesday, and if there is none, then the market condition regarding that would be correct, or would that be valid? Next, you're going to ask whether we reacted to this origin or to this key level at a key time on Tuesday, and if the answer is yes, then the another market condition is valid. And then you're going to ask yourself whether Tuesday is worth trading based on the weekly profiles or based on the weekly structure. And if the answer is yes, then all of these three market conditions are aligned with each other, they are correct, and then you can trade this price action lower on the lower time frame. And from this point on, you'll then move on to the third layer, which is the execution layer. Okay, so this is what the first two layers were about: figuring out the directional bias, and then figuring out or identifying a proper market context on the 4-hour, and then checking the market conditions. Okay, I've just given you a simple graphical overview of what I wanted to say to you, or what I wanted to explain to you. Now this might sound a bit too subtle or too vague for a lot of you, and if that's the case for you, then don't worry about that. I'm still going to be going over actual live trade examples of me applying this framework live on the charts in the later part of the access circuit, in the later part of the chapters. So don't worry about that for now. Okay. So once you've established a directional bias on the higher time frame, and you've identified a proper market context on the 4-hour time frame, and you've also filtered out the market conditions, you'll then move on to the third layer, which is the execution layer. Now this layer right here is where the rubber meets the road. This layer is where everything that you've built so far, your market context, your bias, your filtered conditions, they finally come together and they're finally put to the test, and you finally execute using your entry model or your entry pattern. Okay, this layer is also the hardest out of all of them, because it demands way more than just technical knowledge, and this is where the psychological side of trading shows up. Okay, this layer demands patience, discipline, and emotional control. And if you don't have, and the thing is that most traders don't fail at determining a bias or identifying a context. Those things are easy. They fail right here in execution. And that's the difference between theory and reality. Okay, now this layer has three components: time frame, meaning defining the time frame, entry trigger, and entry model. Now I'm not going to go over these components right now in this chapter. I've prepared a separate chapter for this, so you'll have to wait for that one.